Good morning, everybody. Welcome to the Flow Show, and a busy week coming up. I'm already feeling knackered. I've been running around like a headless chicken all morning, getting stuff ready for today and this week. So it's going to be a busy one, and then we can all clear off for the summer holidays for 5 weeks after that. So, morning to my two colleagues, Stel and Kay.
Hello.
Back into house. How you doing, guys?
Morning, everybody.
Hello. Yeah, I need some holidays, man. I'm really tired. Sorry.
Yeah. I'm surprised we're not seeing some slides of your holidays away. Mind you, we've got enough pictures on Skype while you were away, so no need to feel even more jealous. But have a good time, mate.
It was very nice. Yeah, really enjoyable. The weather was not too warm, so it was perfect. Then we came back to Athens, and it was 43 Celsius yesterday. So a bit difficult to get out of the house.
Yeah, got
But
the
it's
air
okay.
conditioning on. Yeah.
Yep.
And there we go. And so just came back in time for a busy week. Big central bank week, the last ones before the summer. So lots of questions to be asked, and hopefully some questions to be answered. So we will get right into it. Starting off, some small headlines out of China. According to the China Securities Journal, speaking to people within China, that they have ample room for RRR and further rate cuts to boost the economy. So that's coming back on the radar. They go with a big RRR cut. They kept their MLF and their LPR rates unchanged last week. So just a slight pause from those guys, but expected to continue going on. We've heard from Japan's Kanda. He's the FX guy, the FX diplomat, as he's called over there. And funny enough, coming out saying he's not in a position to comment on BOJ monetary policy. Did say that recent Japanese price and wage rises are overshooting the forecasts. Corporate wage behaviours are changing. He did say that the BOJ is likely to revise inflation projections up. That's been added to this morning. We've already heard last week and the week before that the BOJ might be raising their forecasts, particularly for fiscal year 2023, and taking them above target. There was further headlines this morning, Bloomberg citing sources saying that the BOJ are likely to hike their forecasts quite high for fiscal year 2023 this week. So that's something that a lot of people are going to be looking at. They are said to have some doubts still that this upward price momentum will persist. So that's going to be the theme, I think, going into this week's Bank of Japan. I think there's a slight chance of a tweak to YCC, but I think that might be ruled out. It's all going to be about these forecasts. We're not going to get any rate changes or anything like that. So it's all going to be about these forecasts. If they hike their forecasts above 2%, their target, however they try and potentially dumb it down, that move, the market is going to take that as hawkish. So they could hike above 2.0% and give the same lines that they still expect inflation to be transitory. But the market, I don't think, is gonna let them off that, because if they're hiking their forecast, they see inflation coming in higher. So I think there's a little bit of a change coming from the Bank of Japan this week, and the door is ajar for potential changes. So my base case, as mentioned last week, is I still think we come out of this week with a more hawkish slant to the BOJ. I know you're just catching up, Kay, this week, so no pressure. You saw some of those headlines. At the BOJ, we had the government hiking their forecast to 2.6%, well above the BOJ forecasts, or the BOJ target. Stories from Japanese press saying that the BOJ are likely to hike their CPI numbers as well. Do you have any early indications what you're thinking might come from these guys on Friday?
Yeah, I also saw. Thank you. I also saw the Ueda comments. He's starting to look like even more dovish than Kuroda was in his time. But yeah, I was just looking at the next meeting is 2 months, nearly 2 months away. If they want to signal anything, I think this meeting could be just signaling something possibly to come. They will know that if they keep everything unchanged and don't comment on anything, and Ueda keeps his ultra dovish rhetoric that he has over since he arrived, really, they're going to send the yen into a tailspin lower. So yeah, I tend to agree. I think there may be a hawkish hold. The issue is that how is the market going to take that after the usual algo moves and blips? I'm afraid that if they really don't change anything, that the yen could weaken quite a bit over the course of the next month, and then the month after, starting to catch up on what they may do. Because in the meantime, before we have the Bank of Japan, we will have had the FOMC and the ECB, which both likely will add another 25 BPs on top of the interest rate differentials, and that is going to likely weigh on the yen again. I'm just looking at the JGBs. They're trading at around 0.45%, so that's 5 BPs below their band, top end of the band. Doesn't seem the market is extremely nervous about the Bank of Japan meeting so far. But yeah, well, it's basically as you say. They can make it a dovish hold, or in the extreme, put widen the band to 75 BPs. But will it change much? I don't know at this stage, to be honest. It would be a pretty damaging meeting if Ueda just doesn't say anything.
Yeah, that was my worst case scenario. If it's a completely unchanged, no tweaks, no hints, no nothing, I think we're going to see the yen get whacked then, probably well up through 145. Well, depending on where it is after the Fed. But the thing that I just can't shake from my mind from Ueda and the sources piece we got on Friday is that Ueda said that the narrative on monetary policy won't change unless our assumption on the need to sustainably achieve the 2% target changes. Well, if they change forecasts, that's an assumption, which is why that's keeping the door open. And also in these comments Friday, the Reuters sources piece, it said that they will reach a final decision after viewing the latest data, and that showed inflation high and still going higher, and that they will still likely discuss a YCC change even if there's no tweak. So I think those lines are what is pushing me towards the fact that we'll come out of this a bit more hawkish than we are going in. But you know, a tweak might be a bit of icing on the cake if they choose to do it. But certainly lots to consider going into this one, and some of that is the data that we've just had out. We've had the round of PMIs coming in, and just looking at Japan first, manufacturing a little softer again. We've seen this theme coming in pretty much to all the PMIs so far today, particularly in Europe. Services, just a small loss, but still staying strong. But I looked at the details, and just to read what the market guys, or the S&P Global guys, said about this data, and particularly inflation. They said the rate of input price inflation accelerated for the first time since January amid a strong increase in cost burdens at service providers, who largely attributed the rise to increased labour, fuel and raw material costs. Now, some of that is the stuff we know about, wages and labour, but fuel and raw material costs was something that is supposed to be falling back and part of the inflation picture the BOJ see as transitory. So now those, according to the PMIs, have gone up. The report also said high operating expenses pushed private sector companies to raise output charges at a stronger rate during July, with both manufacturers and service providers signaling steeper rates of output price inflation. So there's potentially more inflation in the pipeline for Japan, hence why they might be hiking higher. Their forecasts. Yeah, go on, mate.
And also, if I can add, I'm just I'm catching up, but I'm just looking at the overall data in Japan. They've gone back to a current account surplus. They've gone, well, it's only one month, but they've gone, their balance of trade went back into positive. The PMIs are not dropping out of bed over there, even though, as you say, the manufacturing just slightly negative. The conditions are there for them to start to normalize, right? So I'm just wondering if we would have a surprise. Sorry, I need to jump for 1 minute.
Yeah, no worries, mate. Just to carry on with in the PMI on particularly manufacturing, they said there was further evidence of easing cost pressures, as indicated by the rate of input price inflation dipping to the lowest since February 2021. So there's a bit of the fallout Ueda's been talking about. But manufacturers looked to pass higher cost burdens to clients to a greater extent for the first time since April. So although input prices are dropping, they're still raising selling prices. So that is your core inflation right there, folks. So yeah, even though we are seeing some softness, manufacturing, a tiny move down in services, the important stuff, price pressures are still evident and still in play. And that's going to be a big part of what finally pushes the BOJ into potentially ending their easing cycle. Because if those inflation pressures continue, we're going to see those inflation numbers rising. If they get inflation up to 4%, the market is going to get really hawkish on that. Whether it starts this month, whether they kick the can this week, remains to be seen. But we know if the data continues as it is, they are going to end up tightening or easing at some point, and then
Ryan,
the fun game starts. Yes, mate.
Sorry to interrupt. Just wanted to add that Japan is basically the one of the top economies that have actually not seen inflation that much yet. They're lagging behind, and they naturally have left rates very low compared to other central banks. So they have some catching up to do. And if like you said, if inflation is rising, then even though in the other major economies inflation is dropping, they will have to act. It doesn't matter that the Fed is going to be pausing, and eventually the ECB and the UK and all that, but they'll have to do something. It's incredible because we're all waiting for the big move lower in yen pairs, so the big rally in yen in yen itself, and it hasn't been coming. And every opportunity they have got, they have kind of avoided becoming hawkish, and I don't think they can avoid it for much longer. But let's see. Yeah,
and we've had a sniff of what those expectation price moves are like, because that's a big reason why we fell from 145 all the way down to 137s, purely on expectations. So if they do start indicating something, you get a sense of the scale of moves we might be in for. And if that's matched with all the other central banks pausing, it's going to leave a very quick gap to close on that monetary policy divergence. But they will still take it slowly.
I mean, to be fair, the dollar did weaken against all currencies, so that yen move, that dollar yen move is partially because of the weakening dollar. But you're absolutely right; expectations are changing a little bit, and I'll tell you what, this level at around 137.5 is now starting to become very important. And anyway, let's see. It's relatively clear. 145 on the upside, 137.5 on the downside in dollar yen. I know it's a wide range, but
We've done it this month.
Yeah, exactly.
So yeah, a lot of this move. Yeah, we had the peak Fedness up here that led to some dollar weakness, but a lot of this secondary part was those rising Bank of Japan expectations, and you can tell that because last week we had UEDA, we had the sources pieces going against those expectations, and wallop, we had that gain up and that big move on Friday on that Reuters piece, which hasn't given too much back as yet. So I think we are finally balanced in terms of this level where we are going in, or expectations going in. But who knows? It's going to be hard to try and trade this whole week on pricing. You can say we got the Fed, so I might buy it here, sell it there, whatever. These weeks are going to be difficult to trade it on the levels, because if you want to trade dollar yen, you've got to take into account the data. We've got some decent US data coming. You've got to take into account the Fed, then you've got to take into account the BOJ. So, we could be at 144 going into the BOJ. We could be at 138 going into the BOJ. So you can't really pick a trade now based on levels. I'm going to be looking to trade based on time, i.e. where we are and what's happened after each event. Maybe I'll get an opportunity or not, but I'm going to talk about that in a while. We'll get back to the data, and another piece from Japan was nationwide department sales. They came in at 7% versus 6.3% year on year. For Tokyo, 10% versus 8% year on year. So solid numbers on the retail side of things. Anyway, looking at some of the other data now, as mentioned, PMI day. Australia saw a little tick up, 49.6, still in contraction, but services went the other way. They fell into contraction versus expansion previously. So a little bit mixed numbers there for the Aussie. Over in Europe, Spain PPI coming in minus 8.1%. Not as much as expected, but still we're now starting to see some big negative numbers coming in the PPI numbers. Even look at Finland just above, down 9.5%. Import prices, export prices coming in. This is the cycle we're probably moving into now, where we're going to see a lot of input prices falling out of bed, and that's going to feed through into CPI numbers down the line. Probably about a 3-month lag between PPI numbers and when we start seeing those in the CPI numbers. But as we've been talking about for the past weeks, big negative numbers coming in now, which does set us up to perhaps seeing some negative CPI numbers coming in down the line. I know Stel's talked about this often, especially coming into this year. Prices have to gain more to show a positive number over the year before, and those years were quite big, or the months in the years last year. So to maintain that, it's got to go some. So I wouldn't be surprised if we start seeing some negative CPI numbers probably late into this year or perhaps early next year. But that's,
and that won't be, sorry to interrupt,
ahead.
that will not be a bad thing. It will not be a disaster. It will not be, oh my God, we're going into a deflationary spiral. If you look at the CPI index, not the year-on-year change, there's a CPI, actually, let me find it. Anyway, it's a straight line going up, at 45-degree angle. And what we're seeing now, kind of inflation slowing, is just that line going up at a slower pace, which is madness. The price of things has gone up and it stayed up. So a few months or quarters of negative year-on-year inflation would be very, very helpful for the economy overall. It will not be a disaster in any way.
No, but you can bet your bottom dollar the market will start screaming about deflation and problems, and then we'll get, everyone squawking about central bank cuts, and thus that will provide us with plenty of trading opportunities, because no doubt if the market does that, it will go too far, it will get too extreme with cut pricing, and that gives us a good counter trade. But anyway, that's stuff that may happen in the future, but that's the sort of thing I like to keep an eye on, because that's where you get the big pips fighting those expectations. So just looking at the further data, as I say, PMIs, France, further contraction in manufacturing, further contraction in services, so not looking too good there. Germany, the growth engine of Europe, manufacturing 38.8, was expected to rise to 41. So, you know, massively falling into contraction there. Services, again, we're seeing numbers just softening slightly. They're still in expansion, so still positive going on there, but, you know, edging back nonetheless. And you can see the pan-Eurozone number there as well. Services off a bit, manufacturing further into contraction. Same story in the UK. Manufacturing worse, services worse, just about holding the line above contraction now. That's right, expansion for services. Now, something that was in a lot of the data this morning, again, particularly for the UK, was that price pressures remain, wage pressures remain there. So it's going to be sticky for the BOE in terms of the inflation numbers. I'm still expecting next month's inflation data, which will be for July, to start showing stuff going the right way for the BOE, but there's going to be a little bit of a battle, I think, or maybe a big battle between dropping energy costs and the wage pressures that are still in there. It could mean that we see a significant drop or a decent drop in headline inflation, but that core number just staying a bit stickier. So that's what we're really looking for in those numbers, but certainly that's been indicated by the PMI this morning. Right, coming over to some of the other stuff, and in the UK, job vacancies have risen for a 5th month, adding to the pressures on pay, according to Bloomberg. So just basically highlighting what I've just been saying and what we've been saying here for the past couple of weeks. However, for rate hike odds, they've been further cut back. Now the market sees a 6% peak as a 50% chance. Remember, a couple of weeks ago, we were pricing 6.75% as a peak. Now there's only a 50% chance of seeing a 6% peak. So those are still getting drawn down, hence why there's still pressure on the pound. And we're seeing that in several pairs for that. Right, before we get stuck into the charts, one other bit of news for the ECB was that they are asking banks, or going to ask banks, to provide weekly liquidity data, just to keep an eye on what's going on with liquidity as rates rise and keep rising, just to see if they're able to wear potential shocks from further interest rate rises. So the ECB are going to be moving to weekly reporting for that from September. So we just need to see if anything gets pulled out from that. Right, just looking at what's going on this week. Let's get on the right page. So we've had all the PMI data out today. We get the market, or the S&P US PMI flash coming out this morning. Later on this afternoon. Early in the US morning. That's we don't get the ISM until next week. This will be the first indication of what's happening in manufacturing and services. So that's going to be something that's probably going to feed into the market's FOMC expectations if there's any big moves there. Second piece of big data for the US ahead of the Fed is US consumer confidence. Now, as I say, this data is going to be big for the market more so than what the FOMC decide. I'm not saying this data is going to change what they're going to do at this meeting, but the market is going to have its last minute pricings, and it's going to trade this data. US consumer confidence had a big jump last month, and then we saw the Michigan having a big jump for the July data a couple of weeks ago. So if this number is another strong number, we're likely to see the dollar gaining somewhat into the FOMC. Not too much out anywhere else. We do have some more house price data coming in this week, more regional manufacturing numbers as well from the US. New home sales on Wednesday as well. Then obviously the FOMC. Thursday, it's going to be all about the ECB announcement for that one, but we do get some key data as well, including the first GDP numbers for Q2 coming in as well. So that could be a bit spicy, because whatever the Fed tell us in the FOMC, they may say soft landing, the economy is doing well. Well, if we get a horrendous GDP number, the market is going to undo whatever pricing they put on a bullish Fed, and vice versa if the opposite is true. So that could be a big number for adding to or undoing any of the moves we've had over the FOMC. Further house price data coming out there as well. Friday, some retail sales from Australia, just to keep an eye on, also PPI numbers, and the big announcement from the BOJ. This meeting includes their forecasts, their updated forecasts. So we get to see if they are going to hike those forecasts above target for fiscal year 2023 and how high they take them for 2024 as well. Then France leads the way in some early GDP data as well, Q2 stuff. And we also get the regional German numbers, which then end with the headline number, German number, at 1 p.m. So in the morning of Europe, we'd be getting those regional CPI numbers, which all showed a bit of a steep jump in last month. That was due to the travel subsidies from the year before washing out. So it was base effects. So there may be some more shenanigans coming into that. And that's the data for this week. So busy week, lots to get stuck into. So now we'll look at some of the prices. Unless you lads have got any other headlines you've plucked out that you want to make known.
The only thing I would add is the Spanish elections, which, you know, this kind of stuff become less relevant nowadays. But there was it was supposed to be that the socialist government was going to lose, and the conservatives actually did get a higher percentage from what I read, but they cannot form a government yet. So the socialists might be able to pull through with a kind of broad coalition. Either way, I don't think it makes any difference, but it's worth knowing that there is a little bit of instability there because there's no certainty yet regarding the Spanish government that's going to be formed. But I don't see the euro really reacting to any of that.
Yeah, no, I agree, mate. And there's definitely, we're seeing it in a lot of countries, a bit more of a shift to the right in terms of politics going on. And that might be a situation that bubbles and rears its head at some point. But one to keep half.
Overall, you know, right is, you know, centrist or center left or center right governments. I mean, in Europe, they're pretty much all the same, right? Small differences here and there. That's why I think the markets are not really caring. Obviously, if we did get something, you know, far right or far left, that will make a big difference. And you know, the country that comes to mind is France, which has a possibility. You know, far right has had very good support in the last decade or so. So let's see what happens there. But for now, Spanish elections not giving a result yet, but I don't think it's anything to worry about.
Yeah, cheers, mate. Thank you very much. So let's get stuck in some pricing then. And speaking, you know, dollar yen, and just to reiterate again, it's difficult for me to you know, try and formulate a plan to trade between the Fed, the ECB, the BOJ. So, I mean, one of the ideas I did have is, you know, maybe take advantage of certain moves if they happen a certain way. You know, for example, if the Fed is quite bullish, quite hawkish, indicates that a second hike is a large possibility. We're going to see the dollar rally. If I then feel that the BOJ are going to come out of this meeting with more hawkish and going in, that suggests that dollar yen might go down. So I'm going to be looking at, as I say, trading the clock rather than actual price levels, unless obviously we get something really juicy coming out. So for dollar yen, I'm going to be looking at maybe selling a rally. I'm still long this one from down below, 138 on the back UEDA, and then that sources piece on Friday. So I've got some margin in the trade here. I might start yanking my stops up quite significantly now. If I get a pop on the Fed, I'm going to probably cut out probably all of the position, or maybe keep a little piece on, depending on my view for the BOJ. But then potentially turning short into the BOJ on the back of that and see what happens on that one. For the ECB, I'm going to be looking at the euro. I think again, just trying to trade between it. I think the ECB are potentially going to be seen as more hawkish than the Fed. Even if the Fed do indicate a second hike, it's likely we're going to get a pause on that point. I can't see the Fed really pushing a strong case, and the market has already traded a peak Fedness, if you like. So I do see the prospect that Lagarde won't want to give in too easily on a September hike. So she'll probably make the case the market is a little less expectant for a Sep hike, which is pretty much following what we saw from Fed rate expectations. So it's a little bit of copying, catching the same cold. The market's still pricing a 60% chance of a September hike for the ECB. The Fed for September hike is only something like 15-16%. So you can see the difference in rate expectations there. And I think that's pretty fair, personally. So the euro, I'm maybe looking at buying a decent dip, maybe down into 110s, 109s, that sort of area. We'll see where the price wants to go. Get that over the over the Fed, run along into the ECB, see what happens for there. But if we get down to somewhere like 108.30s, you know, it's probably a bit of an extreme move. I'll look to maybe pick some up technically anyway, because I don't see anything really changing in this short-term move that we've seen anyway. But for now, the top side is definitely going to be solidified after we had this move. This is almost similar to, you know, what happened with dollar yen at 145. You know, we had a decent rally up. It's topped out. We're now seeing a bit of a pullback. We're either going to keep going all the way down, or we're going to find a level. As I say, 110 is probably one I'd keep my eye on. Maybe we find a bit of a bounce there, not back up to 111, and the price action is similar. The market will be balanced going in to the ECB, and then we can only react to what happens after that. And we know what they're going to do. So cable, I can see this one doing a bit of a headless chicken this week. It's going to follow loosely the expectations for all the other central banks. You know, if the markets get dovish, the Fed and the ECB, it's going to get dovish the BOE as well. As said earlier, already drawing down expectations further for how high the BOE are going to take rates. I still think 5.5, 5.75 at the top for BOE rates, but that's going to be determined by the data. So we shall see if the market is right in its pricing. Probably is, because it got too extreme, getting up to 6.75. Some even called in 7%. That was getting bonkers, as mentioned. So a bit of room to roam for this one, I think, this week. It'll be, as I say, more of a follower than a leader. We have knocked under this 128.5. We had a dip below it last week, then a bounce. It's now a bit wishy-washy, this 128.5 level. Just not being able to close below this fib, though. So it's a bit undecided here as to whether we are going to keep going or whether we're going to find a bit of a bottom here as well. Obviously, the Fed and whatever goes on with the data, it's going to be a big decider for that. So technically, not really looking to get involved here. Maybe down, you know, low 127s against his 50 fib might be a technical play. But with these risk events, I'm not keen on just stepping in front of the techs that much, because these events will override that. As you can see, Euro Sterling is probably more indicative of the state of play. Those Eurozone PMI numbers doing a lot of damage here as well to the euro. But we're not falling out of bed. Still maintaining decent margin on my longs from down here. So I'm not too worried at the moment. I'm expecting the 86.10 level to provide support, as it's been an on-off support and resistance area for quite some time. The level I was looking at on the way down. So we'll see what happens this one. We've definitely got decent resistance going into the 87 level, as I was expecting. Still need to move above 87.20 to really open the gate, I think, to further gains. But again, a bit of balance maybe. Did think we might see some profit taking on Friday, and you know, we saw some of these lows, but it had another pop up and then a bit of a sell-off So yeah, a bit more balance here. I think it's all to play for. If we get if the ECB is a bit dovish and we get a move down here, I think I might add back into the bits that I chopped off already from the lows, but I think that might be a stretch getting back down here. Dollar CAD, talking about this one on Face as well last week. Had a couple of goes at getting over this 132, 132.10, couldn't do it. Now we're just off a bit, 10 pips, 130.90. It's really not giving much either way. Technically, if it's not getting through 132, then the chances are we're heading lower. If we get down to 131s, low 131s again, I think that'll be indicate that we might be getting a bit of a break. Depends on how we do. If we break this low in particular, that might suggest we're going to have a further move down. Still just edging lower off after this high is up to 134. We're still getting a series of lower highs, so it's keeping the pressure on. So something's got to give in here. It's not going to stay this way forever. Will it be the Fed that gives us the clues, or will it be Canada data giving us some clues on that one? Stelman, if you got any thoughts on gold, silver since you've been back? Gold sort of holding middle of range really. We had we highlighted the the 1980s. That's been solid resistance. This seems a bit of a pivotal area at the moment, the 60s, ahead of the bigger support down at the 30s.
Yeah, I mean, gold and silver are still within ranges, and they're not breaking out or breaking down in any way. And this is probably because the two main drivers of pretty much all markets, yields and the dollar, actually they're one, aren't they? They are at very, very important levels. So the 10-year US is at 382-ish. We've been talking about that level for ages and ages. It was a breakout level. Now it's become support, 382 to 384, let's say. And it's still it's still hovering around there. So it's a huge decision it's going to make. So either we have a false breakout in yields, which is going to be quite bearish yields, and which means that both yields and the dollar go lower. Usually they move in tandem, which means that metals go higher. Or we see yields bouncing off these levels and heading towards 4%, which is definitely not going to be good for metals in the short term. In the long term, as I've said before, in the medium term, we don't care. Yields go up and down, dollar goes up and down, metals go higher. That's the broad picture. But we're not trading with 5 or 10-year horizons, so we're trying to ascertain what's going to happen next. And for me, the DXY is at 101.20 something, which again is very close to that 100.80 level, which was a big support. As far as I'm concerned, we're still hovering and trying to figure out which way around we're going next. And gold and silver are going to follow that. What do I think? I think they're both going to resolve eventually to the upside. But, if yields do bounce, gold is going to be heading towards support at 18.95. Simple as that. While we're within this range, I have no trade at the moment. I have nothing. I wait for this range to be broken one way or the other.
Yeah.
Boring,
no,
I know. Sorry.
Phil,
Yes.
are you still in your long silver?
Yes, 23.08, 09, just above 23. Yes, I like that. Right. I was an idiot because I had said for a while, if we do see anywhere between 22 and 22.30, I want to buy more. And the pace of that descent scared me.
Yeah.
And the dollar rally as well. I was like, oh, this looks like it might want to go to 19. So I hesitated, and I'm obviously kicking myself. But yeah, I am still in that, and I will stay in that. The question is, where do I add? That's the question.
Yeah, I think this week is going to give us a clue where because I'm still long my long term as well. I had been trading that around, and I'm still long in there, but I'm looking at it and then looking at Ryan's picture and mine at the same time. We are in a bit of a zone here. I'd say between 24.5 and 24.25 or so, which could be a bit of a decisive area with everything that's to come this week. Because imagine that for silver at least, imagine that we are getting those confirmation of those weaker PMIs and the interest rates perhaps going and yields going perhaps a little lower. I think if they combine with weaker data, silver may be the worst one of both gold and silver. You know, the gold-silver ratio may start to creep higher if it's accompanied with a bit weaker data, especially those PMIs. And then we have this second quarter GDP out in the US. I'm thinking of letting some go if yields come off and the metals shoot. I think in silver, if we get a print well above 25, it's perhaps good enough to offload some, just some, to be able to reload more if we see it lower. Gold may be a different story. Gold may be a completely different story, because that's going to be really on the back of the yields, right?
Yeah, I agree with you. I think 26 is big for silver, and if we get somewhere between 25.5 and 26, I will definitely unload some, just like we did last time, remember? So I think
exactly.
I'm gonna unload a little bit. I don't want to be caught without having any while the big bang happens. You know, that's the thing. But
but for the big bang should happen if we see yields just slipping lower, and but the rest of the economic data holding up relatively well.
We don't want a deep recession. You know, that's not good.
No, that's not going to help us.
I think on that front, we are seeing again the US outperforming all the rest in the data wise. So you've still got to put all things US ahead of Eurozone, UK. Maybe not the UK just yet, but in terms of economic performance, I think the US is likely to achieve soft landing more so than the others. I mean, Germany looks in all sorts of trouble at the moment. So we could probably expect a recession from those guys sometime soon, and France as well, I think. It's all going in the mix. It's funny what you said, Stel, about psychology of trading. You know, I see it all the time. We see it all the time. You know, when you're trading up here, everyone wants to buy at 22. But if you suddenly get a move down to 22 that's pretty violent, suddenly you start second guessing yourself and questioning, do you really want to buy it now? And it's an important thing of trading, the psychology of stuff. You've always got to judge a move on its merits at the time. It's okay saying trading 24.5, I'll buy at 22 with open hands, but why it gets to 22, you have to ask those questions before you jump in. It's always easy to buy it when the price isn't there, isn't it?
Yeah. And you know what? I'm always a little bit more cautious than I should be, and sometimes it works against me. But that's how I am. I'm not saying people should do what I do, but that's what I do.
Yeah, I'm the same. I'm cautious. I probably talk myself out of more trades than I put on. That's the way we are, isn't it? That's the way we're wired.
The annoying thing is that I was talking about that level for weeks, and I was saying, if we get there, it's going to be great. And then we get there, and I hesitate. It's like, come on, dude. Anyway, it's okay. It's okay.
Yeah, right. I did exactly that with the dollar mix the other day when we broke, that 1700 and 1695. Oh, I had my sell stops in. I pulled them over. I can't remember what the event was. I think it might have been US CPI or something. And then it went. I didn't have any shorts on. Pulled the sell stops, and it went all the way down to 1670s. Absolutely gutted. But we can only trade what we feel at the time.
Exactly.
Can't do anything else. Anyway, Kay, you got some early thoughts about price action for the Bank of Japan? I'm not going to say unless you are ready to show some charts, but I delay that until tomorrow.
I can, but I have just a couple to show. Actually, on the euro dollar, I have I spotted an interesting. Something interesting there. If we look at the euro dollar where it stopped, it's a 61.8 of the pandemic decline. So we did a spike high here in the euro dollar through 2020, and the rally that we saw over the past weeks stopped on bang on the 61.8, and I think that, and if we talk about option market is not pricing these kind of moves. Let's start with that. But assuming that we could have some really big moves, I think this 112 3/4 is going to really be a big gateway to whatever may happen afterwards, if it would happen. Okay, but it's going to be a very big hurdle. It's also the top end of this channel here that we have been developing all the way down from the lows. So I think this 112 3/4 is really going to be key. And perhaps you guys talked about it, but I was off over in the last week or so. But it's really key to me, this 112 3/4. On the other hand, it may seem a little less obvious, but on the other hand, I think there's a few levels here. We've always been no, that's too low. Where was I? I had something here in these 108s. Okay, 108s have been old levels, but if you look at the bottoms here, and a few bottoms here last time as well, before we did the move, the last jump higher, I think these 108s here, they are going to be very important as well. That's for the bigger picture. You have like 400 points, and I know it's the same as your 800 points in dollar yen or so, but I think for the medium term, it's also always useful to keep an eye on what's happening in the medium term. I think those low 108s are again going to act as a zone of no return if you get through it. So that to me is going to be my big picture to start the week, and then we can drill down. Actually, we were talking about that in the chat room this morning. 110. DK at 65.75. I have a line here at 75. I have another one at 110, around 110.50. That's going to be your intraday, I think, support, and the 110.50.80, call it half 3/4. And on the top side, we've broken down here below this trend line. You see, we've broken down. We were in a retest of it this morning. And then the data came out. So this is your first level here, I think, around, call it 111.40, 45.50 or so, 111.5. And then on the downside, this half 3/4, 110 half 3/4. I think those are the nearest levels that we are going to keep an eye on. And already this afternoon, I think on the US PMIs, they could either send the dollar back down, if they confirm the weakness that we saw in the European on the European continent or European zone this morning, we could have a rebound here up to perhaps 111.5, which probably going to be neutral-ish in the very short term. If we get down there and cap it, then we're going to range a bit. But if the US data would diverge and stay stronger than expected, there's probably going to be a bit of pressure here on this 110.5, and we could have, like, I don't have much for a big figure if we break below 110.5 down to 109.5. I don't think we are going to break this bigger range before we know everything about FOMC, ECB. As I said, the option market is actually pricing both events combined at roughly 60 pips, which is nothing if you take into account there's the two biggest central banks in the globe decisive for whatever may happen, and they're only pricing in a 60 pips move over both meetings combined. So there's perhaps a bit room for surprises there. But if there weren't to be any surprises, then I think, as you rightfully said earlier, then we're going to have a look at this second quarter GDP in the US. That's going to be a mover, in my opinion. That is going to be potentially actually a bigger mover than what the FOMC and ECB could bring us if the option market is right. And the options market, it's a deep market. I think there can be surprises. I think it's too low, priced too low to move. But there's a lot of volume in there. So they can be right. Option markets are not always wrong, you know, and that's what I meant. So that's for the euro dollar. Yeah, your dollar yen, you've said it right. There's a few lines that were converging towards the 142. I think that's a good, decent enough zone here. 142, 61.8. Bit of a trend line, but this is going to gradually go higher. But your 142, call it figure 10, is going to be where it's probably going to be playing. What is looking like a bull flag, Brian, if you can be more precise? The dollar yen could be, yeah, could be a bit of a bull flag here. But then we have seen this move, pretty violent, right? First indication of it getting back towards those lows would be a break under, well, call it 140, yeah. I think 140 is going to be your first level where we watch it confirmed through 139.80. This one here, this one here. 139.80 figure is probably going to be where we see the measurement between strength and weakness of the dollar yen right now. That for it, you've done the cable. One that really defies the laws of gravity here is euro yen still. I'm not a big euro fan. I'm going to say it straight away. So I think this one, if the Bank of Japan would start to show a bit of a stronger hand towards normalization, whatever, 156 and then big level again, 155. I'm going to be closely watching those levels, especially if European data continue to show weakness. I'm going to have a very close eye on the euro yen. We are already in a call it a triple top formation here, around 158. So that's your top end. If it breaks above 158, figure 10, figure 15, I think then that idea of perhaps starting to show a return lower if the Bank of Japan does anything goes into the bin. What else? Yeah, we've seen during my absence a big move on the Norwegian kroner. It's a shame because we were looking at that very long, or for weeks and weeks we were looking at this, and I only took like a very small move on this, but I really missed the big move lower. Do bear in mind though, 11.13 on the euro NOK. It's 38.2 of the last move, the last leg higher, big leg higher, and it's the also prior top, and it's where we stopped. So keep an eye on this 11.13. Read a couple of things in over the weekend saying that people start to have more confidence in the Norwegian kroner. So perhaps we should be looking, let me quickly grab this one back. Perhaps we should be looking at any bounces you have here into the 30s, which capped also earlier this month. Perhaps we should have a look if we get a bounce closer to this level, whether it's going to be rejected again for the next leg lower, which could then take us back down sub 11. But just keep it in mind. We also will have, I think, when is the 31st is only next week Monday, right? So we will have to wait for Monday to know what the Norges Bank is doing with the Norwegian FX. Dollar Norway actually crashed through the support here. If this head and shoulders really seems to have and potentially still play out, if this is a bearish flag or pennant or however you call it, we are not far from where it should cap if this is to be a bearish continuation formation. And if you look at the width or the height of this head and shoulders, it should end up not too far from this December low. It's even a bit lower if you take the measured move, but if this gets confirmed, then we get back sub 994, 995. Then I think there may be another few percentage points to be done. But therefore, I think the not only Norwegian kroner should stay strong, but also the dollar weaken further. So we need the dollar to weaken further to complete this this move, I think. But yeah, keep an eye on what's happening already. Not too close from here on the top side, because if you break out of this pennant, then we may see a higher correction, maybe back up to the 200 DMA, 1035 or so. That's about it, mate, for the time being. I'm actually, but I forgot to mention it as well. I'm keeping a very close eye on what's happening in Euromix. We are having the half month Mexican CPI coming out. People are expecting it to weaken a bit, but as you see, they this has been kept close to 19 in this zone here. I think for as long as we are below 1910, nothing has changed. We really have to get above 1910 for it to go higher. As long as that doesn't do it, I still think there is a chance we will just continue to do what we did. We had those big correction periods, and this looks like in amplitude it's big enough, but in the global picture it really looks like a flattish kind of or flaggish kind of correction as well. So for as long as it's below 1910, I'm still quite bearish on this one. It's also a prior low here, and here it's been trading as well. So that's what I'm looking at right now.
Thank you, mate. Good to have you back, and same with Stel.
Thank you.
So I hope got a busy week as mentioned, so we'll keep you updated on all the analysis as the events pass during the course of the week. We shall call that a day for today. Thank you as always for coming to the Flow Show. Have a great day, have a great week, lots of pips, stay safe over all this trading. If you're not sure, you can sit on the sidelines and pick up the pieces and pick up the moves out afterwards. But anyway, we shall see you all bright and breezy tomorrow. Thanks guys, see you tomorrow.
Thank you.
Thank you, everybody. Cheers, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.